Renato, hi.
Kako si? Jel me čuješ?
Čujem, bok.
Super, super. Jesi u Zagrebu sada?
Jesam.
Okay, okay. When are you coming to New York?
Um, in October for a few days, then in Las Vegas, then back in October. Um, but I'm moving next year,
Next year.
April.
Next year.
Yeah,
So it's all planned out, right?
yeah,
Yeah.
pretty much.
So I missed you. I missed you at I think last time there was a conference in New York. I think it was SALT.
Uh-huh.
And then
Oh, yeah.
yeah, it was SALT, and then you were at another one in Florida, right, as well.
Yes, in Orlando. But then I'm coming to Miami in January, end of January, early February.
Gotcha. There's another conference that's the
The Global Alts, that's the
yes,
one.
yes,
Yeah.
yes. Do you get a lot of value from those events?
Absolutely. So with Salt, we had tremendous value. We had three institutional investors coming in after Salt. That
Awesome,
was really
awesome,
good. Yeah,
awesome.
it
So
was good.
so so uh I have a bunch of questions. I'm already recording and we'll kind of go through it. We'll start off with kind of like a high level and kind of move more towards the
Sure.
fund and kind of the specifics of it and so on. And
Okay.
we'll get it out there. But tell me a little bit about kind of, I think the last time we talked was April.
Mhm.
Since April, I think your fund was maybe sitting around 10 million or so. So what are you currently sitting at right now?
Currently 17, so we're gonna start September with 17. So it's been going well. Can't
Awesome,
complain.
awesome. Okay, cool, cool. All right. So I want to go back to kind of back in time, um, you know, before you studied economics and so on. In terms of like big interests that you had growing up, what were they? And then how did that kind of guide the pursuit of economics in school and post?
So yeah, I mean, the interest in economics was kind of, well, I have to say it was partly my parents, right? Because they were both in that space. But also kind of my I always liked, believe it or not, looking at like currencies and stocks and stock market even since I was a kid. There was just something about it that attracted me. Maybe it's the whole money thing, but it was not. It was more than that. I think it was about excitement and something interesting. But then, kind of as I went from my education, I kind of diverted from that. I didn't go into finance entirely, right? So I went more into political econ. So it was more like theoretical. It was macro initially, so macroeconomics, and then more kind of going into the philosophical part, right? So political econ, um, tying together, like public choice theory with macro, with economics in general, saying that you can't really understand economics if you don't understand politics, right? So it was more theoretical path, which was my kind of academic direction, right? But however, fast forward, I kind of returned to my initial one true love, finance, even though I took a very long detour, but it's still within the same field, but it was a detour.
Sure, sure. Something interesting, at least this is what happened to me. What got me engaged in markets was just kind of like the movement, the idea of being able to make money. But what kept me in it was kind of the all the details, the process of how do you actually make that money, right? So how do you structure
Right.
trades? How do markets actually work? Credit and positioning, all those things actually kept me involved. But what got me engaged was kind of like the flashiness of it all, the potential to make money and
Yeah.
so on. So yeah, it
No,
sounds
absolutely. That's absolutely the main motivation, right? And you learn things along the way, and they make it more or less attractive. And in our case, it was more attractive, so that's good.
yeah, yeah. So you ended up going to the London School of Economics and
Yeah.
Oxford. Why those two in particular, and maybe not come to the US, for example?
Yeah, I mean, before that, I was in the US, so I had my undergrad degree in Zagreb. I'm
Nice.
from Croatia, right? And while I was there, I was mostly doing like macro stuff. That was what I was again, also theoretical and macro. But then during 2 summers in 2008, 2009, I went to sorry, 2009, 2010, I went to the States. I was at Berkeley in the summer school for 2 months, and then at Harvard the year afterwards. And those experiences kind of, I was thinking of, staying here in Zagreb and doing my education in Zagreb. But then, after those experiences, it was like, no, I should go abroad. The reason why London and not America was because it was closer. So far, but again, it doesn't make any difference at all in general. But it was kind of closer, and it was less expensive for us, especially on the master's level, right? Because in Europe, you do a master's and then you go for a PhD, so you can finance it gradually, right? So yeah, that's why.
Gotcha. Did you
But
get
but
much?
also obviously LSE is, I mean, huge, right? And it
Yeah,
was so, but that was kind of, if you look at those reasons. But on the other side of the spectrum, the LSE really had the political econ program, which is what I wanted to do, right? In
yeah,
the States, I could have, if I wanted to go immediately, I would have to chosen like a econ PhD, like a straight econ PhD, and then from that branch out, which is something I didn't want to do, right? And LSE offered that opportunity, so that's why.
sure. Did you get a lot of value from those summer schools?
Oh, absolutely. Yeah, yeah. So it showed me that I can compete in an environment which I wasn't sure or whether or not I would be able to compete, right? And I got straight A's from both of my courses that I took at Berkeley and at Harvard. And they were like, I took a macro course at Berkeley and like some contemporary political econ course at Berkeley. And at Harvard, there was some monetary theory, which was taught by a former assistant to Milton Friedman. That was fun.
Okay,
And I took global financial crisis. That was really good because the crisis was just starting, and yeah, it was a very that was a very strong interest of mine. Like, so it was when the financial crisis started in 2008. I was my second, I think, third year of uni,
yeah,
and it kind of formed me ever since, right? All the research was basically around that. So that I kind of found my niche, right? And then I was especially looking at the financial crisis from a political econ perspective, right? So what were the political causes of the crisis? What happened beneath? Why were these banks allowed to take so much risks, et cetera, et cetera?
sure, sure. Okay, so I kind of want to fast forward in time. You wrote a couple papers. You had, your theses. How did you develop those theses, and how long did it take you to research, write, and kind of defend them?
So it was most of my so you're probably talking about like after LSC and after everything, right? So I did most of my research in like the fields of, again, political econ, specifically corruption and lobbying. So I had papers that were, or economic voting in general. But when I came to Oxford, the focus was mostly on this collusion between politics and economics, right? So the corporate world and the political world, right? And it started from a paper on corruption, where I was looking at Croatia specifically. I was looking at the connections between firms and people in power and how it affects their re-election chances, and the level of trying to measure corruption through public procurements given to specific firms. And I show that there is a very strong impact of corruption on re-elections chances in Croatian mayors and Croatian cities and municipalities, unfortunately. But then it kind of moved on. The second paper was more on bank bailouts in the US and the United States during the 2008 crisis, which is kind of, again, as you mentioned before, the focal point of my research interest ever since uni, right? So I wanted to show whether or not banks that were better connected to their congressmen for various different ways, we can discuss this further, did they get a better bailout deal relative to their assets, right? And they did, obviously. And so once I had these two ideas, which I already had the data for before, it was just like, let's try to connect this into a more unified theory of how the corporate execs and politicians connect between themselves, and how these connections impact economic outcomes. In my specific case, I was looking at distributions of income, so inequality. And from that arrived my third PhD paper at Oxford, and that was the one when I had this huge data set of about 1 million corporate execs in the US and the UK, tying them to politicians, and then seeing the people that are better connected having much higher salaries, right? So specifically in the US, I think the impact was $150,000 annual salary higher. So I was comparing, so you have to be a corporate exec. When I say corporate exec, I mean either CEO, so C-suite, or member of the board, right? That's it. That's the level. So you're comparing two corporate executives in the same company. One is connected, one is not connected politically, and who has a higher salary. And the premium is about $150,000 for the guy who is politically connected. How do you measure political connections? So if you worked with this person before on a senior level of government, right? Or you belong to the same organization. So I had this data set, this great data set on like country club memberships, that sort of stuff, right? Golf clubs, charities, etc. And that's how you can. I mean, it doesn't necessarily make you friends, but you have a way of, getting to the guy if you need it, essentially. And
Yeah.
so out of that whole venture of my academic work came the book that I just published this year, Elite Networks, and it's out. You can buy it on Amazon, Barnes and Noble, wherever in the US. And it's currently trending well.
Awesome. I gotta get a copy. I'm gonna read it.
Yeah,
But
absolutely.
in terms of, I guess this is the thing. I remember, this was a while back, maybe a couple years ago, but it was like you had Bezos and it was like Jerome Powell. They were like at the same like party or whatever, and there was like
Right.
they were grilling Powell on what was discussed or like if they had interacted or whatever. But that just got for some reason that kind of reminded me of that. Um,
Yeah, again, and
yeah,
there's a subtlety of these connections. I was looking at that specifically during like, the financial crisis when you had Tim Geithner and Hank Paulson uh, basically had regular daily meetings with the CEOs of the top eight banks, the eight biggest banks, right? This
sure.
was normal. This was documented in the New Yorker and the Times, whatever. And I was reading those transcripts, and you can see that these people are friends, right? And there's a great paper on that. It's called I don't remember the paper, but they have the social connections in a crisis. I think it's something like that, where if it generally matters to be connected, but in times of a crisis, it matters even more. You can get to the person that you need to get in order to, in this case, bail out your bank, especially when there was the height of panic. We're talking September 2008, right?
Yeah. So your findings in Croatia, did that end up ever having kind of an impact on policy at all? Yeah,
Surprisingly, yes. Not as much as I was hoping. But so as a consequence of that, so my main finding was that you have these very suspicious levels of public procurements where companies with, for example, zero employees and the single bidder at the tender get a huge deal from the government, right? On the local level. I was only looking at the local level. Sorry. Um, and then basically, one way of trying to combat this would be to introduce complete budget transparency so that the public is able to see, to witness every single procurement expenditure that comes from the government, right? So we're talking, big procurement deals all the way down to receipts for lunches, dinners, that sort of stuff. You can see who's dining with whom, even salaries of public sector employees. So everything basically, have the whole budget fully transparent. And we actually started implementing this project in a few cities in Croatia, and we did it. The Bjelovar was the first one. It was a smaller city next to Zagreb, and we had a couple of other smaller ones. And I think it kind of ended at like 5 or 6 cities that got this implemented fully, completely, saying that we have nothing to hide and we're open and completely transparent. By the way, all the mayors who did that, who implemented our project, significantly beat everyone else at the elections in the subsequent elections. So it does help. I'm saying corruption helps you get reelected, but being fully transparent helps you even more. That was kind of the conclusion. So we wanted to do this project in more depth and in more detail, and giving it out to a wider audience of mayors, but the interest was simply not there, unfortunately. What did happen is that we were able to implement this as a formal part of the budget law. But now the problem is that once the bureaucracy gets their hand on it, they watered it down, right? So we did say so in the law explicitly it says every single local unit of government needs to have full transparency. But it's the devil is in the details. You have the second layer of the bureaucrats defining what does it mean to be fully transparent, and when you get that, you basically water down the whole bill, and you don't get the same impact. So I'm kind of I'm done fighting those battles. That's behind me. I'm doing something completely different now, and yeah,
yeah, yeah. So
that's it.
so you have a couple of big partners that kind of followed you from academia right into kind of like this whole business of finance and so on. But before we kind of get into kind of what you're doing and with the hedge fund and so on, I still kind of want to talk about a little in regards to some of that research and so on. So I think, when through our last conversation and what I was reading afterward, it was um, in terms of how you more accurately or precisely predicted these elections, it was finding this in-between group of people and then giving them a greater weighting, right? So
Mhm.
talk a little bit about kind of like how you developed that methodology and how did you initially think about monetizing it, right? You didn't immediately think about, hey, like let's create a hedge fund out of this. What did you potentially think about?
I didn't immediately think I wanted to do a hedge fund, but I knew that it had to have some applicability on markets. So we'll get to that, right? I mean, the original idea was actually, so my two colleagues, Dan Vinković and Mile Šikić, so one is, all three of us are Croatians. Dan is a physicist, Mile is a computer scientist. And all three of us were in the academic sector, right? And they were professors. I was a lecturer at my university as well. And so we wanted to try to find this new way of making surveys better in terms of making them more predictive, right? Trying to find a better way of doing that. So we were kind of looking at what Nate Silver is doing in the U.S. And since all three of us are, coincidentally political junkies, elections were the first thing we wanted to apply this thing. And so we started by doing Croatian elections back in 2015, and it worked really well. I'll explain how the methodology basically works. And then what really propelled us was the Brexit referendum correct prediction and the Trump 2016 correct prediction, right? And very, very precise, very accurate. And this kind of got us going to let's not write this as a paper, which was the initial idea. We wanted to write a paper of a new prediction method. We said let's do let's try to monetize it. Let's try to build a company. Now, what's the whole logic behind it? You have two combinations. One, so two parts basically. The first is wisdom of crowds. So you ask people what you think is going to happen and what everyone around you thinks is going to happen. So let's stay with elections, right? So who's going to win, Trump or Hillary, or Trump or Biden, Trump or Harris? And then that's the first question. The second is, what do you think other people around you think who's going to win? When you get to that in your area, right? When you get to that second question, you kind of force people into thinking about, putting themselves in other people's shoes. So you're kind of forcing them to switch between system one into system two thinking, right? So the whole Kahneman-Tversky model, we apply that as well, right? And you're giving them an extra 45 to 60 seconds just to think about something, and you're forcing them to think differently and give you better, precise answers. So we found that, and that was very fascinating. And the second part is it's not enough, right? The wisdom of crowd itself. So it wouldn't be enough to do that, what I just said, to predict Brexit correctly or Trump. So what we had to add was the whole networking element, right? And this was really the crux of our approach. So trying to figure out who's mingling with who is friends with whom. So for example, if you are, again, election setting, if you are in a liberal bubble or a conservative bubble, then you only hang out with like-minded people, which is most of us do that, right? But then you have a very low ability to predict what's going to happen outside of your bubble, right? So what I want is, instead of people being in bubbles, I want people that are in more heterogeneous groups. So some of your friends are left, some of them are right, some of them are centrist. So that means you have a higher probability of being right. It doesn't necessarily mean that you get it right, but you have a higher probability. And so the whole methodology is basically playing with probabilities for different individuals. And these probabilities are weights. So that's how weights are determined. So your opinion, maybe you are better connected than I am. So your opinion is more valuable than mine in the survey. And that's how we set it up, right? So not every person's opinion matters in the same way. That's the general idea.
Got it. And where would these surveys be accessible? Did you do this through social media or like how would someone be able to, you know?
Well, yeah, I forgot to mention that. So the crucial part is social media, right? So we
Okay.
did it everything back with elections. We did everything on Facebook. This was before Cambridge Analytica, where Facebook was very open to giving you that type of data, where we can see. We didn't take any personal information. We didn't care, unless what we asked for in the survey. So gender, age, whatever. But from Facebook, we only took the network link. So we wanted to see who's friends with who. And if your friends came into the survey with you, then we can connect you, right? Now we're doing everything on Twitter and LinkedIn. So we're sourcing those networks because they're allowing it. Facebook doesn't allow it anymore. And this was, back in since what 2018 to 2017, after the whole Cambridge Analytica scandal, Facebook kind of dropped the whole thing. And yeah, so we had to switch platforms, but not a problem because we're still, again, people are typically on the same platform, so all of these people came to other platforms, so we still have these huge networks available. Again, we really don't care and don't know who these people are. All we know is who they're connected with. That's the point.
Yeah, but that was going to be my next question was, now that you're kind of using more so these, Twitter or LinkedIn, do you think, if you were to go back in time and you would have used these platforms, would have you come up with the same results? Or
That's an excellent question, actually. Could be, right? Because I mean, again, I remember that we learned a lot on the Facebook data, definitely, right? Because it had the best, um, uh, uh, the data was kind of, how should I put this? It was most versatile. There was a lot of it, and there was a lot you can do with it, right? So obviously, this gave you a bigger pool from which you can pick the data that you want, pick the not just the data, but the relationships between the data that you need, right? Again, a lot of this was based on theory of network physics, for example, and this is like for network science in general, which my two partners are especially good at, and which I later became particularly good at. But it was so all we needed was a good data set to kind of fit the theory to see if these things actually work, right? And it did. So back to your question, would the Twitter data been? I don't think it would have been as helpful as the Facebook data, right? I think the Facebook data was really helpful. But then once you learn what you need, then you can basically do it on any other platform that has a network.
okay, gotcha. I kind of want to start moving along into kind of the markets conversation.
Okay.
So, how did you come up with the name? Is it Oraclum or
Oraclum, yeah,
Oraclum? Okay,
Oraclum.
yeah. How
It's
did
a
that
it's a
happen? Yeah.
it's a Latin word for prediction, right? So we're
Okay.
making prediction models. So Oraclum is a Latin word for prediction. That was simple.
Okay,
Yeah.
okay. And so prior to starting kind of the hedge fund and so on, did you have market experience and how did you learn about markets? What books did you read or,
Mm.
really yeah.
I did, right? So I've been like on and off investing like since what 2011, 12, something like that. So for about more than 10 years, 12. But I've been really kind of um, investing with options again in a retail capacity since 2018, since Tesla calls, right? That was the name of the game back then. And
Okay.
I went through the whole trader experience. I mean, I love those books by Schwager, right? Those market wizards,
Yes.
because I went through the same process as most of these people, right? Initially you make money on something and you're like, oh my God, it's super easy. I'm so smart, right? And then you lose a lot of money on something else. And then you start learning, right? Gradually. So I did have some experience with options, but then this really kind of I really took my knowledge and the level of options trading since 2021 when I was testing the methodology of Oracle's methodology on markets, right? Because then I said like we need to do this with options because it gives you the convexity, right? And that's what we want. Because if
Mhm.
we're predicting it, 60%, 70% of the time, which was what we typically the accuracy rates that we had, then it was like, let's see if we can, how can we multiply these returns?
Yeah.
Um, but yeah, so essentially, I did have some experience, but it exponentially grew over the past few years for sure, and especially since I have the fund.
Sure, sure. In terms of, what did the fund structuring process look like? And what guided your decision to actually create a hedge fund versus maybe, creating an ETF structure,
Mm.
allowing more people to maybe access this?
So the hedge fund versus ETF is costs, right? For ETF, I need it's much more costly. I need about $250,000 just to start the whole thing,
Okay.
which is something that we didn't have at the time. But our goal is within the next few years to do the ETF potentially, so we can open this up to a broader audience, especially because a lot of people in the survey are participating and they would love to be investors as well, but we have a cap of $100,000, so they obviously can't make it. And
Yeah.
so it would be great for them to kind of participate at the same time while also being invested in it. So you have an even stronger incentive to be even better in the survey, right? To perform good.
Yeah.
So why the hedge fund? Again, after our the just to go back a little bit, after the whole Brexit and Trump thing in 2016, we decided to start a company. We started in the UK, of all places in Cambridge, by the way. Again, no relation to Cambridge Analytica, but
I
it
know,
was
I
it was funny.
know.
Um, yeah, especially seems like, oh, those are the guys that predicted Trump, and they're in Cambridge. There's something suspicious. No, no, we're like we're the good guys. We didn't do anything bad with your data.
Yeah.
Um, anyway, so and we mostly did market research sort of projects, right? It was about like elections, market research, and then we did a lot of like public sentiment stuff during COVID. But then after after the 2020 election, which we again got correct, Biden versus Trump, all the swing states correctly. Then we and at the time I had a bunch of clients in the finance industry buying these predictions for elections, and I was like, okay, now is time is finally ripe. We start testing this on markets. We had some money. We could hire people to do this for us. So we started the whole project, and it's like let's do it for 2 years, a year and a half. If it doesn't work, that's fine. We can always pivot back to what we do,
Yeah.
the market research stuff. But if yes, then something we have something. And this story grew exponentially, right? So I took my own money. I took $20,000 of my own money and put it in to test this every week. And I brought it to 54,000 after a year and a half.
Yeah.
And I was doing this very transparently. I was posting like, screenshots of what I was buying and selling on my newsletter. People could see, they can see our profits and losses in not in real time, but like weekly after I reported. And before I would always send like to people that were filling out the survey, before I make a trade, I would send them, okay, this is what I'm going to trade. Like, and so that we had this level of transparency. And people liked it a lot, and some of them decided to become our investors, right? Especially like our biggest investor currently is the guy who's following us on Twitter and through the newsletter, and a bunch of others as well. So I think like the decision to start the fund came in like summer 2022 after like almost a year of testing, when people that were following us were saying, I want to give you my money, right? Why don't you turn this into something more than just like trading on off of your account? I'm like, okay, let's do it, right? So we started this whole process, and I was like, I remember talking to my wife about it, and she was like, I told her, I always tell her, like, you need confidence of a guy who doesn't know anything about something and still does it anyway, and that's what we did. I don't know anything about hedge funds, but we started a hedge fund anyway. Um, that's the level, right? But obviously we were learning along the way, and before even starting the hedge funds, I was talking to lawyers. I had all these meetings,
Yeah.
and with potential investors, and then just before we opened the fund, I was like, okay, let's see the interest, right? So I did this survey and asked people, so people who were regularly in our newsletter. So we're thinking of starting a fund. Would you like to invest? Um, and we got about 10 million commitments, right? $10 million of commitments. People saying, yes, if you start a fund, I will invest 100,000, 200,000, 500,000. Obviously, one thing is, hey, I will commit to something. Another thing is actually pay the money. So once we started the fund in February, we only opened with about 2 million, right? So it was a bit different. But the whole story of the hedge fund is like very different to what other people, when they start hedge funds, they start it with like 100 million, 200 million, or billion or something. We have this whole startup hedge fund thing, right? Where we want to bootstrap it all the way up. I think we have a good thing. The performance is good. Investors trust us, so we kind of building it gradually from the ground up.
Sure.
It's not a conventional story. It's very unconventional, especially. But on the other hand, I don't need the standard. I don't have the standard cost of hedge. I don't need a team of analysts. I don't need a Bloomberg terminal, right? I don't need any of that stuff because we have our method and we're trading it very simply. It's a very simple strategy. So yeah, so far so good.
Sure. What is it, what does it cost to run your type of operation, right? It sounds like it's a lot slimmer, right, than a lot of these other ones. Yeah.
Exactly. I mean, in the first year, that was last year, it was about 100,000, right?
Oh,
Was the
okay.
where the cost is not 120,000, something about that, right?
Sure.
This year, it's bigger just simply because I'm kind of increasing the whole marketing scope and everything, so it's going to be about 400K.
Okay.
But still, not with our profits, we're very easily funding the whole operation, right?
To actually create the fund structure and so on, was that pretty cost intensive as well?
Surprisingly, no, it was about $30,000 altogether, right? So we
Really?
did it, and it was the setup in Delaware. Was the
Okay.
fund. I found the good lawyers um, that have this as a kind of a standard procedure. So basically, all the money that I earned myself
You
on
use
the,
it for that. Yeah.
basically, yeah,
Okay.
yeah,
Gotcha.
use it for the
Gotcha.
fund.
All right. So what does your investment process look like from pre to post trade, right? So you're getting the signal to entering the trade to managing the trade as the market moves, managing your cash and rebalancing that. What does that look like?
Sure. So again, it's very simple. We get the signal every Wednesday before market opens, right?
Yeah.
We have a few things that, so we know this, excuse me. Once we get the signal, we want to determine the strength of the signal. And there's a few things that we do in how to determine the strength of the signal. And then we would typically place positions about an hour after the open, right? So not like in the first half hour, definitely not around an hour after open, so about 10:30
Hmm.
Eastern time on Wednesdays. And we would keep the position until the end of trading on Fridays. And so we figured that this is kind of the optimal timing for our prediction. If we write, we only risk about 2% of our portfolio per each trade, so every week, only 2%.
Okay.
And we only buy options, right? So we buy options, we buy premium. If we're wrong, the premium expires worthless, we lose 2%, right? If we're right, then we make multiples of that. That's kind of in a nutshell.
Sure.
Now, obviously, there's, uh, uh, um, other things that we can do. So, for example, um, we have this trailing stop strategy, for example. So if you make a 1.5%, then you kind of increase the stops, and then you keep increasing the gradual. So trailing stop, classical, right? We used to do a bunch of other things. So, for example, I would if we're very strongly in the money, if we're making a lot on the next day on the open of the next day on Thursday, then we were kind of testing if what would be better if raise the stop loss. So if the markets go back down, we're out, or simply put like a 0 day to expiry option in the reverse direction. So
Uh,
these kind of things we're constantly kind of trying to figure out which strategy works best within the specific signal. Sorry. Okay.
it's okay. All good. All good. And you do buy options, but do you do any sort of I think you said last time you do spreads, right? So you do
Uh-huh.
like a
Yeah.
vertical, right? Okay. Yeah.
Yes. So
Um,
spreads, but
yeah,
we always a net buyer of a spread. So we always net
sure.
buyer of premium,
Sure.
never net
You
seller.
don't do anything a little bit more complex like some sort of multi ratioed structure or so on. You just keep it,
No,
okay.
no, we keep it simple. We keep it simple. We used to, right? So this is a great story, right? So the whole thing, right now it's great. We have this fund and it's working, right? But the whole thing started as almost a disaster, right? So out of the gates, February and March last year, we were down 15%. And when we came to our investors, those that came in with the first 2 million, we said, if we lose 20%, you're out, right? So, the fund is down. And we were down to 15. So it was kind of very tricky. So what went wrong against us? Several things. So we decided a little background. When I was trading this on my own, right, I was only risking 10% every week, right? So that was my risk. So with
Sure.
$20,000, I was risking 2,000. I was buying premium for 2,000. Um, Also, so a part of that was our Iron Condor was one of the strategy. That's why you asked me, because so the Iron Condor was one strategy that we were using, because we wanted to. Our methodology is good in both direction and precision, right? So we noticed that we are often very close to 2% between where the market is, where the market ends up, right? So our prediction is pretty much within 2% of where the market ends up about 85% of the time, which is a lot, right? So I was thinking, an iron condor strategy is an ideal strategy, or condors better than butterflies for a number of reasons. A strategy to kind of make money out of this, and it did work really well when I was trading it on my own in 2021 and early 2022. Not in like the second quarter of 2022 because the markets was mostly going in free falls. But then our directional strategy more than overcompensated the loss on the condors every week. But then, ever since the introduction of 0 day to expiry options, the pricing of the Friday options changed dramatically for us, right? So the risk reward before was about 2 to 1. So I would risk let's say, $100, I would gain $100 and risk $200, right?
Yeah,
Now
yeah,
I would gain $100 and risk $800, right? So if I'm wrong, I lose 800. If I'm right, I lose 100. So basically, one bad week sets me back. I need 8 good weeks to make up one bad week. So it was kind of not really an option anymore for us. And that strategy, we noticed it hurt us a lot in the first quarter of 2023, which is why we dropped it, right? We
yeah.
had a bunch of other things inside as well, dropped all of it and just focused on the directional options, the spreads, and that was it.
Yeah. My first thought was how much of that is the volatility environment. That's like the first thing I thought about
Yeah,
because yeah, I was trading actively then, and that's the first thing I thought of. Okay, so you dropped you dropped the condors, and then did you change how you traded the verticals, right? The sizing of those positions, did that change?
absolutely, right. So the sizing was, again, as I said before, I used to risk 10% of my portfolio.
Sure.
When we started the fund, we started with about 5%. And then when this was very quickly getting out of hand, we kind of lowered it down. When we were down minus 50%, we lowered it to 1% exposure,
Okay.
right? So it took us about 5 months to get back to break even, gradually increasing this exposure. But now we kind of found that 2%, well, 2 to 3%, depending on the strength of the signal, is kind of our optimal point, right? We don't want to go beyond that because we don't want to risk any more than that on a weekly basis. So yeah, it definitely affected position sizing.
Okay.
And we're talking about you're talking about volatility in March last year, right? During the Silicon Valley Bank, the whole that was when it really hurt us as well.
Yeah. Now I'm assuming if the volatility environment changed enough, you would potentially consider doing something more or even, because that, what you're saying is like, the condor it actually could work really well. It's just that the
It,
volatility environment
no,
isn't
no,
that.
true. It could work, but that's the thing. It does work for us over 80% of the time, but the risk reward is no
Yeah,
longer good for us. That's why we don't want to engage in it again. Even though, like, I'm looking at the data, every now and then we would like to look at what would happen, and more or less it would be flat, slightly above flat, and that's not,
sure.
there's no point in doing it.
Okay, okay. So this brings me to my next question. Do changes in volatility and positioning affect how you trade that underlying market? So, you know, in the beginning of August, right, we had a bunch of volatility. I understand you probably most likely weren't in any positions at the beginning of the week. I think it was the 5th of
It was
August.
Monday. Yeah, it
Yes,
was
yes. So
Monday.
you actually avoided that, right?
Yes, we did. Yeah.
But did that impact, do those rapid changes in volatility? I know you also talked about looking at positioning too, right?
Mhm.
I used to do some work in positioning as well, but in terms of like where you're structuring that position too. So does that, kind of summarizing it, do those large changes in volatility, do changes in volatility in general impact how you're, structuring these trades and where you're structuring them in the chain?
No, not the structure, right? Not the structure, but so for example, let's go back to that week, right? So on
Sure.
Monday, markets were well, we were basically flat. We were in bonds and cash,
Okay.
nothing else, right? Waiting until Wednesday. We ended the week positive, ended the week 1% plus 1%. And so the volatility, that's again, obviously the last 2 weeks you're benefiting from the compression of vol, right? So everything's going, vol is going down, markets go up, and it was an easy trade basically in retrospect, right? Which was good for us. But in those kind of moments, say that if we held puts during that day, it would have been amazing for us. If we held calls, we would have only lost the premium. So that's it. So that's why the volatility, no matter how big it is, doesn't impact us in a negative way, right? So because we're not sellers of options, we're sellers. That's a different problem, right? That's why I don't want to sell options. That's why we basically are only buyers of premium. Because in that case, the most I can lose is the premium, and we know that our risk. For example, if a week like that happens, we're wrongly positioned. That's fine. We lose 2%. Move on to the next week. We're done.
Got it. Got it.
Not a
Now,
big deal for us, right?
sure,
I mean,
sure.
it would have. So I noticed what I noticed on the day was like the huge mismatch of bid and ask prices, right? That was
Yeah,
so that's something that to consider. But let's say if I had puts and there was a huge mismatch, we probably would have placed it at a mid and sell it at that level, and that's it.
sure. How are you executing these orders? Are these just market orders? Are you actually setting a limit and then
Limit or always limit orders.
okay, gotcha.
Limit.
And are you what are you using? Are you using one of the ETFs or you use the cash settled indexes like the SPX and stuff?
It's Pi. We're using Pi. Yeah, not the cash settled. Yeah.
Okay, if you do grow with large enough size, would it be more cost efficient to maybe go into something like the SPX?
Yes,
Um,
absolutely,
okay,
absolutely. Not only that. So right now we're one of our institutional investors is coming in, and
okay,
they want us to do the same strategy on futures. So
future
ES
options, yeah,
options, future
yeah,
options. Yeah.
yeah.
And I think like looking at their pricing, I mean, should make a big of a difference. They have this ability to run the trades through them, be cheaper for us, and I think that would, yeah. We're looking at the data, and yeah, the strategy works as well.
Would you now, is that when you're looking at the data, is that like you're actually testing trades in real time, or are you kind of like back testing it and so on?
Backtesting, in this case,
Back testing.
backtesting. Yeah.
Okay. And if you were to go live with either ES or SPX, what would you do that with smaller size and then test it out and see how that's working and then scale it up?
Probably, yeah, yeah.
Okay.
That was the initial agreement, right? Tried it with
Gotcha.
smaller size and then kind of push it up as we go along.
Okay, cool, cool. So next
So I
question.
mean, this opportunity for sorry, just to
Yeah,
to
go ahead.
interrupt. Right now we're small, right? We're $17 million fund, which is not a
Sure.
lot. So I trade, a couple $100,000 worth of premium every week, which is not a lot, right? Once we become bigger, um, SPY is obviously immensely liquid, right?
Yes.
SPX is even more liquid. So there's only a bigger ES is even more liquid than that, right? So there's the pool of liquidity just keeps increasing. So as we grow in size, I think it's very easy for us to scale in that case, right?
Yeah.
So it shouldn't be an issue.
Yeah. Okay. Gotcha. And so you said you risk 2%, right? So with the other whatever that is, 98%, is that still in T-bills or others?
90% is in T-bills, and the 8% is like a cash buffer.
Cash buffer. Okay. And so because you're always out of these spreads at the end of the week, I'm assuming you're pretty liquid. So if there's ever like redemptions and stuff like that, it's just
Yeah,
very easy for you.
not a problem for us. Yeah,
Okay,
absolutely.
gotcha. If interest rates fell, if interest rates fell or, you kind of had a significant lull, nothing was happening, would that change how you're, kind of the proportions or how you're investing that capital?
Yeah, probably would. Right now we're basically taking advantage of the carry, right? So
Okay,
there's like it's a very easy carry trade. You just leave it for a year and get 4%. And the reason that's why, right?
sure.
Once if we're back to like the pre-COVID interest rate environment where everything's close to zero, or immediately post-COVID, like 2021, it probably would have been a different instrument. However, I would still vouch to keep most of it in bonds just because of the safety. So we think of it like the Taleb barbell strategy, right? You have 90% is something very super safe, and then 10% is something that's very, or in our case, 2% is something that's very volatile and very risky, but give you a higher, well, not even risky in our sense. You can lose it, every week, but
Sure,
once you're
sure.
right, you get it back.
You're locked in for a year. Are you using you're not using like box spreads or anything. You're actually in bills, right?
We yeah, we're actually bills.
Okay.
But I think we will switch to box just because of the tax implications. This is something
Yeah.
that I've only recently figured out from my accounting team. So
Yeah,
I think
I've been
it's a
using
better
I've been
idea.
using box spreads for a while now. It just like makes
Yeah,
more sense, especially
absolutely.
and if you're do you have portfolio margin as well?
No, I don't think so.
Basically the way the broker tests your margin, it changes a little bit. And so the amount of, you might not have any cash on hand, but you still have all that buying power that's available. So you
Right,
can
of
continue to do
course.
things synthetically, right?
Right.
So, in time as you're maybe changing things up or you're adding different strategies and so on, that can help or whatever. But how do you monitor the strength of the trading signals, and do you scale back if that signal starts weakening?
Oh yeah. So this is something that's kind of an ongoing process with us, right? So there's several things. I mean, I can't really go into the specific details,
Sure, sure,
but there
sure.
are several. Yeah, sure. I mean, but there are several things that we're looking at. So the signal strength, we have these KPIs that we're looking, and we would know looking at like the past 4 or 5 weeks, is it getting better or is it getting worse, right?
Okay.
And if it falls below our crucial indicator, then we're like, okay, let's try to see, let's see where what the problem is and what's happening and how can we fix it, right? And
Sure.
this can be due to a number of reasons. This can be that, let's say the response rates in the survey fell for some reason, which happens sometimes during like the boring boring periods of the year.
Hmm.
Or it can be due to another number of different factors. But we can pretty clearly see when this is happening, and prevent it from the start, right? So we can allow ourselves maybe one bad month the max if it can start going against us in like 4 or 5 weeks in a row.
Okay. Gotcha. In terms of, you said you talked a little bit about AUM, and you have kind of a unique pricing structure, right? And so can you talk a little bit about that? I think you charge a flat 1.5%, and then
Yes.
there's like
Uh,
a 8%
20.
hurdle, and then you charge
Yeah.
25% on that gain. So talk a little bit about that.
Yeah. So yeah, exactly, right. So 1.5 is management fee and 25% is the performance fee subject to an 8% hurdle.
Sure.
And this is accounted for on a quarterly basis. So every quarter we need to clear 2%, and then we charge 25% above that. However, there's a high watermark as well, so
Yeah.
we can only charge fees if we're making money on a quarterly basis consistently, right? So if we lose money, not until we so if we make money one quarter, lose another, so in the third quarter we have to make up for this loss and above the first quarter in order to charge the performance fee.
Okay, got it. Despite being systematic, kind of,
Mhm.
you're still executing these by hand, right?
Yeah.
You're actually inputting these orders, setting limits, and so on. So there is a potential that you might have your biases and emotions and so on. How do you factor that in? How do you manage that? What have you done over time to kind of help you manage that and just execute?
I mean, I'll be completely honest. I took a coach, right? A psychology coach
Okay.
to guide me through this. No, seriously, I mean, I saw that it was necessary. I mean, I had my share of losses before the fund. I've had my share of like winnings and losings, like going for the emotional problems. But then running someone else's money and running your own money are two completely different things, right? You have much higher responsibility for someone else's money.
Sure.
Um, Plus, you have to report to these people on a regular basis, telling them, how much money you lost. And um, so, and this was especially problematic for us back in March when it was like, the fund just started and we're down 15%. And what do we do now? How do I look at these people in the face again? How do I face them and tell them? But yeah, so the thing is, um, I did a lot of exercises in that and try to, help myself. But the problem is not the problem, but the solution is essentially um, just stick to the process in a sense that the less I meddle, the better, right? And we've learned this very early on, right? The less we start meddling with other things, the better our investment returns are. So like completely remove our own biases and just following the so following the process is one of the KPIs, right? So
Yeah.
we have the performance KPIs and we have this KPI trying to figure out. So the ultimate goal right now, I'm doing it because we're a small team, right? As we expand, I'll hire traders. I won't do any trading anymore, and it's like, so literally just like, follow the process. That's it. We would like to. So we were talking about automation, like to have the whole thing automated. But then, it doesn't always perfectly work, right? Because sometimes the machine is not gonna do the job that you want it to do. That's why I think like human traders are still because we're not high frequency traders, right? We don't need the machine to do it in like nanoseconds, right? Um, I think that still we're gonna depend on humans to execute the orders, but it's gonna be by following a system.
Yeah, it's kind of interesting. You might have like the best process ever, or
Mm.
someone might give you the best process ever. But as soon as you start thinking, everything goes out the door, right? You have to
Absolutely.
just stop
Absolutely. That's
thinking.
why. So the people I hire to do that, I'm like, clear your minds completely. I don't want you to think about it at all. Like
Yeah,
we have the responsibility for this, not you. So yeah, just trade the book. That's it.
sure, sure. That's why it would be easier. So do you ever, I'm just curious, do you ever have a signal you're putting on a position, but you're thinking in your head, it's like, oh, this isn't going to work, but you still kind of go through with it because it says,
Obviously, I do. Obviously, I do, right?
yeah,
But I
yeah,
kind of, I've taught myself not to, it's signal. If I start deviating from it, I'm only going to mess things up, right?
Sure,
Yeah,
sure.
maybe this week I'm going to help it, but the next week I'm probably going to destroy it. So,
Okay. Yeah.
but it
Uh,
does go for my, I mean, again, the psychological mindset thing, right? The trader mindset thing. It's like, I know all these things. I still think about it, right? I still, get an urge, right? But
sure.
kind of pushing yourself um, to make this fully, completely emotionless is a process, right? So it's going to take a while, obviously.
Okay. So the hedge fund to me in my head is like Act Two, right? Do you
Uh,
have in mind like an Act Three? Like what would that look like? Would you potentially, work in government, like have more of a formal role there because of especially the research you've done and so on? I feel like that's a logical thing.
nah,
What
I
would that
know. I'm so away from governments that, it's
okay.
it's liberating. I used to be, very, as I said, like all three of us are political junkies. I like to follow politics. I like to follow
Sure,
current affairs and everything. But, ever since the fund, it's like, why did I even do this before? I'm asking myself, like, why did I even care about these things before?
sure.
So at this point, it's really difficult for me to think about Act Three,
Okay.
especially now when we're like in the middle of building this. But, obviously something, um, it depends on how much money I earn, right? Philanthropy or something. We'll see.
Yeah, yeah. Okay. Have you done any work into these next set of US elections, right? The presidential election. And if so, can you share any results or like any early indications?
This is a big argument that me and my two co-founders are having. So one of them is really, really against us doing this,
Okay.
because of the focus on the fund and our investors and everything. And even, when I asked some investors, some of them even said, like, you should focus on the fund. And I think that makes sense, right? So we're probably not going to, even though I want to do it, just for the record, I really want to do it. But we're probably not going to end up doing anything for the elections,
Okay. Okay. Interesting. If
unfortunately.
if you were to
Because
do
I
it,
see it as a great marketing tool, right? I see it
I
like,
do
oh, we
too.
predicted it again, right? I mean, I think personally, I think it's an easy win for us, right? But we'll see.
I think it's great. If you got this one right, you'd be on Bloomberg, you'd be on CNN, you'd be on
I
everything.
know,
Great.
I know, I know.
Okay, so
But
but
anyway,
if you were to do it this time around, are there any lessons you have from like the last time around that you've done this, right? Trump, the Brexit, Biden 2020.
um,
What would
I
you
mean,
just
yeah, I
do?
mean, just like I would streamline much more towards the key swing states. That's at this point, like, and this is, by the way, believe it or not, like over the last two U.S. elections, like 2020 and 2016, it was the Pennsylvania was the key state, right? As soon as we saw, like in 2016 in our survey, that Trump is winning Pennsylvania, that was like for us, that was it. That was the signal that Trump is taking this election.
Okay,
Same thing in 2020, when like at no point did Biden ever lose Pennsylvania in our surveys, right? So that was like the turning point for us. So alongside obviously Michigan and Wisconsin,
sure.
etc. Um, Ohio and Florida, we saw that they were going for Trump, and that this was going to be and usually, like, you remember, like before this election, whoever won Ohio and Florida became the U.S. president, right? Not this time because you had Pennsylvania and Michigan in the
Sure.
other direction. So if I was doing it this year, I would focus on literally a handful of swing states and just like maximize it, because the rest of them are like you can just follow the surveys. It's not going to change a lot.
Okay.
But focusing on like Pennsylvania and Michigan, in particular, Ohio, Florida, most likely Trump. But then I would also look at like Arizona, North Carolina, Georgia maybe, and then just Pennsylvania, Michigan, Wisconsin. That's it.
Okay, gotcha. I recently watched a podcast with Ken Griffin, and something that he said, but stuck with me because like I felt like this is something that I've looked at much more so was studying your winners more deeply. I mean, obviously you study your losers too, but studying the winners more and not allowing the losers or allowing yourself to get hung up on those losers. So, is that something that kind of resonates with you? Because you do
Yeah.
have this process, you have this signal, right? You kind of follow it, right? If you were to lose, it just be, the signal, or it's not necessarily the process, right? So, what would you say about that?
No, no. I mean, yeah, that's a good point. I mean, I get excited for the winners much more than for the losers.
Yeah, of course.
But
Yeah.
I've learned to teach myself that the losers don't matter, right? It's just move on. there was this great quote by Federer, right, the tennis player. He was doing this speech at Duke, where he
Sure.
was saying, I actually have it somewhere. Yeah, I have it here on my wall. So like, he won only 54% of every shot, every point that he ever played, right? But he won 80% of the matches because it's like for him, it's not about the point, it's about, it's the most important thing in the world. And when it's gone, it's gone. You move on to the next one. It's the same thing here, right? So every week is like, oh, if we lose 2%, we lose, we move on, right? But when we make a big win, obviously we're very happy. But the point was also like a part of the whole psychological training was like let's let your winners run, right? Because for us
Sure.
we saw that if you don't cut the profits too soon, if you just keep a trailing loss strategy or something, you can get much more, right? That's why we have weeks where we make 5% or 6% a week, which is really good, right?
Yeah.
So there is something, right? So study the winners because for us it all comes down to like 5 or 6 weeks per year where we make a significant return, and that's the bulk of the return of the fund.
Sure.
Because
Sure.
everything else kind of cancels out, right? The winners and the small winners and the small losers cancel out, and then you have these 5 or 6 really big ones that stand out.
Okay, gotcha. In terms of, and kind of rounding it out because we're at the top of the hour, but in terms of who do you look up to? Like, do you have any mentors or like people, especially in regards to the market stuff, how you're trading and so on? Is there someone that, you kind of looked at closely or maybe taught by? Who is that? Or who are they?
Yeah, I mean, so again, having read those book on traders, I loved every single interview there, right? It was
Sure.
so revealing, so very comforting, right? Um, but like so obviously, when I was younger, I idolized George Soros, right? That was kind of everyone wants to be. But what we do is completely, it has nothing to do with how Soros trades. He's like this, big ideas guys, and I can never compete with that, right? It's the same thing with guys like Ray Dalio. It's a completely different way of trading.
Yeah,
Um, what I would like to emulate is someone like, I want to say Paul Tudor Jones, right? So something like that, right? In that vicinity
sure.
would be
I've
better.
actually I've actually been rereading Alchemy of Finance and
Okay.
kind of reflexivity, right? And
Yeah.
one thing I kind of appreciate with him is kind of like this cowboy
Yeah.
style of trading where he says he's not like some sort of mathematician or anything, right? He
Mhm.
almost has like he just tries to be so in touch and in tune with markets, right? That he's like feeling them almost or whatever. I forget his
Absolutely.
actual phrasing, but that's something is okay, so cool. Do you have like a favorite book recommendation?
Oh yeah, I mean,
Beyond your book.
on trading, yeah. Apart from my book, I really love Taleb. Taleb was kind of the
Okay,
someone who opened options trading for me, right?
sure.
After I read oh my God, I'm blanking his third book, Anti-Fragile, right? After I read Anti-Fragile, it was kind of, oh,
Okay.
right, these options are interesting. Let's see let's see how this
Yeah,
works. But yeah, so his books in general are really really good for me. I love him. But in terms of like learning trading, I think like psychology books are great.
sure.
Like Trading in the Zone by
Okay,
Douglas, right? That's a really good one.
I got those.
And the one and Schrager's book, is it Schrager? Am I pronouncing it right? Jack
Yeah, Jack
Schrager?
Schrager.
Schrager,
Schrager.
yeah. Something like that. Yeah, yeah. His books on like traders, interviews with traders are like fantastic. Because again, reading them was like, oh man, like all these guys did the same stupid mistakes that I did, and like look at them now, right? They're these
Yeah,
amazing traders, and I'm thinking like so stupid because I'm doing all these errors, and everyone does it. Everyone went through the same process. Ah, yeah,
right.
I'm super smart. I made money on these first two trades, and then it kind of you go through this. Um,
Awesome. Awesome. Okay, well, thank you so much. Wanted to keep it just an hour
thank
long.
you,
I think we
Renato.
covered a lot.
Yeah,
I will keep you posted. This will be on YouTube, and I'll do like a newsletter
awesome.
write-up as well with it.
Just like the one you sent me, right? Awesome, awesome,
Yeah, 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 yeah.
perfect.
And thank you so much. Hopefully meet you
Thank
in
you.
person sometime soon, or when you're finally in New
I'll
York.
let you know when I'm in Miami. If you're around the city, definitely. Yeah.
Okay, okay, awesome, awesome. Thank you so much. I'll talk to you soon.
Thank
Okay.
you.
All
Bye
right.
bye.
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 Bye.